Welcome to the Microcap Brief. In our past episodes, we've covered the core risks of microcap investing, from NASDAQ compliance and reverse splits to the dangers of M&A. A common thread through all of these topics has been the ever-present threat of dilution. Today, we are going deeper. We're moving beyond simply recognizing dilution after it has already happened. We're going to teach you how to see it coming by decoding two of the most common and complex tools companies use to raise money: equity lines and warrants. Think of a company's total number of shares as the water level in a swimming pool. A traditional stock offering is like watching a huge fire hose get turned on all at once. The water level rises dramatically, and everyone sees it happen. But equity lines and warrants are different. They are more like a slow, steady leak from a pipe and a collection of rain clouds gathering overhead. The effect can be just as dramatic, but it's much harder to spot until you're already underwater. Let's start with the slow leak, the equity line of credit. An equity line is a pre-approved agreement a company makes with a single investor, allowing the company to sell new shares to that investor whenever it needs cash. Here's how it works. The company gets permission to sell, for example, $50 million worth of stock. Then, whenever they need money, they can draw down on that line. They might tell the investor, "We need $1 million. The investor then buys $1 million worth of brand new shares directly from the company, typically at a small discount to the current market price. This is the drip, drip, drip of dilution. Each time the company draws down, new shares are created, and the water level in the pool rises a little bit. You won't see a big press release for each of these small sales. The dilution happens quietly in the background, often only revealed weeks or months later in a quarterly filing. The cumulative impact of this slow leak can be massive, and it can easily sneak up on uninformed investors. Next, let's talk about the gathering storm clouds, warrants. A warrant is a certificate that gives the holder the right, but not the obligation, to buy a share of the company's stock at a fixed price, called the strike price, before a certain expiration date. Warrants represent potential future dilution. They are the storm clouds overhead. The rain doesn't start falling, the dilution doesn't become real, until the warrant holders exercise their right to buy the shares. This usually happens when the stock's market price rises high above the warrant's strike price, making it profitable for them to do so. The danger here is the overhang. The market knows these clouds are there, and the threat of a future downpour can keep the stock price from rising. Even worse, many warrants have tricky clauses. If the company later sells shares at a lower price, the warrant's strike price can automatically be lowered, making the future dilution even more severe for existing shareholders. Like the equity line, you won't get a big press release every time a warrant is exercised. The water level just quietly rises. So, why is tracking these instruments so critical? Because the dilution they cause is a stealthy erosion of your ownership. Waiting for the next quarterly report is like waiting for a flood warning after the rain has already started. You are learning about the damage long after it has been done. Furthermore, how a company uses these tools tells you a story about its financial health. A heavy reliance on equity lines can be a red flag, signaling that the company is struggling to fund its operations and can't get money any other way. Your key takeaway is this: in the world of microcaps, dilution isn't just a single event, it's often a continuous process hidden inside complex financing deals. Tracking it in real time isn't a luxury. It's a fundamental requirement for protecting your investment. Your homework is to become a financial meteorologist. For any company you own or are watching, dig into its latest SEC filings. Look for any mention of equity line or standby equity purchase agreement. Find the section that details all outstanding warrants. You need to know how many clouds are overhead and how big the potential storm could be. Set up alerts for new 8K filings. An announcement of a new equity line is a critical weather alert you cannot afford to miss. By actively monitoring these instruments, you can protect yourself from the silent creep of dilution. Thank you for listening to the Microcap Brief.
Stay vigilant, stay informed, and always do your own research.